Hello everyone, welcome back to Fundrise Finance. I've recently come across an amazing ETF from Invesco, which is the Invesco Russell 1000 Dynamic Multi-Factor ETF, ticker symbol OMFL. I'll discuss this ETF in detail, what it does, how it performed, and how it can fit perfectly into one's portfolio. So without any further delay, let's start the video. So the last few years in the stock market has given a lot of information to us. From the depths of the pandemic losses, the markets really took off, rising more than 105% through end of 2021. But from then on, what we saw was a massive fall. The markets almost fell almost 25% from their peaks of late 2021. Then we saw a small recovery through the end of the year, and eventually they ended just shy of 20% in the red. What this shows is there are different factors that play a role, and as a retail investor, we can't be on top of each and everything. So that is where I came across this ETF from Invesco, which is Russell 1000 Dynamic Multi-Factor ETF. So Russell 1000 actually represents the 1000 top companies by market capitalization in the United States. So it goes over and beyond the S&P 500. So we not only get the 500 largest companies, but also some of the mid caps and small caps also in this configuration. And then what it does to this Russell 1000 is the crux of the ETF. It works based on the current economic cycles and market conditions, reflected by expansion, slowdown, contraction, or recovery. So, just to know what they are nothing but business cycles, which are like a cycle of expansion and contraction that economies undergo over time. So, this chart makes it more clear to understand. So, when we are at the peak of our economic activities, and after that, we start to see a slight recession, and then we see the economy going down into a trough, and then we see a recovery, and after that we see an expansion. So if we relate those cycles to what our market saw in the last few years, after the lows of the pandemic, we saw a massive expansion that ran all through end of 2021, and from then we saw a slowdown in the economy. So this is where we see in the media where people get asked, are we in a recession or are we about to go into a recession? No one knows an answer to that really. So when the top economists themselves don't know the answer to that question, I don't know how a retail investor can answer that. So ETF like OMFL is what will guide us through all these stages of this market cycles, where securities are assigned a particular score from each of the five factors, which are value, momentum, quality, low volatility, and size. So if I take iShares as an example fund house, for each of these factors, they have an individual ETF like VLUE for the value, MTUM for the momentum factor, QUAL for the quality factor, USMV for the volatility, and finally size for the size factor. So you see, instead of having five different ETFs targeting each of the factors individually, the OMFL ETF targets all of these in one package. If we dig deeper, how does this ETF know which particular business cycle is the economy in? They make use of all the surveys that happen frequently, like the manufacturing surveys or the consumer sentiment, monetary, housing activities, the labor market conditions, which are indicate the economic growth, and also how is stock market behaving in that country. That gets us the market sentiment. Based on these, Invesco will get to know which particular cycle they are in. And what this is it's like a feeder to their calculation engine, which will determine which particular cycle the economy is in, whether is it in recovery or is expansion or it's a slowdown or a contraction. Based on which cycle it is determined, that particular factor will be used to determine the holdings in the ETF. So let's say if we're in the recovery phase, size and value are considered. If you're in expansion phase, size, value, and momentum are considered. So if you're in a slowdown, low volatility and quality factors are considered. And in the contraction phase, you have momentum, low volatility, and quality considered. So you see, the way this is constructed is depending on the market cycle, your constitution of the ETF is changing. So it's like an actively managed. So this fund and index are reconstituted and rebalanced based on the economic indicator signal changes as frequently as monthly, which means every month the market conditions are considered and accordingly the ETF is reconstituted and rebalanced, which makes it seem that this ETF is like an actively managed ETF, though it is not, but still, based on all these factors that we just saw, every month based on how the market is, whether it is an upswing or a downswing, whatever it is, it is adjusting itself. The rules are working in the favor of the condition the market is in. And all of this quasi active management sort of thing is just for a very good competitive expensive ratio of 0.29%. If you ask me, the best of the best fund managers charge more than 1 or 2% for what this ETF is doing. Overall, I really like what this ETF does and provides for the low expense that it charges. So this is the methodology document for the index on which OMFL is based. So as you just saw, the four economic business cycles: recovery, expansion, slowdown, and contraction, and the five factors that are considered: value, size, quality, volatility, and momentum. Now let's see how this multi-factor approach has performed over the last decade or so. So we can see from 2017 through 21, so that's 15 years in the past, the dynamic multi-factor has performed the best in what? 1, 2, 3, 4, 5, 6, 7. So 7 out of 15 years, it has been the best. No other factor did so many times as a topper in the last 15 years. I wish there was 2022 also provided here. That would have been an amazing year to consider, given what all we saw in the last year of lows in the market. But instead of 2022, if we consider 2008, which was the year of the Great Recession, in that year, the multi-factor approach gave result of minus 28% compared to every other factor. Even when we consider the Russell 1000 itself, it came at the last. So this means the ETF or the index is able to adapt itself to the market conditions and give the best result possible. Now let's go to portfolio visualizer just to back test how OMFL has done since inception. And for to start with, let's compare it against the S&P 500. Let's get 2017. That's where the OMFL ETF started. Let's include year to date, cash flows, none. It's just a one-time contribution, no real balancing. Display income, yes. Let's give OMFL as 100%, then VOO as 100. Let's change the portfolio name so that it's much easier to understand. OMFL and VOO and analyze. So we see results from Jan 2018 onwards because the OMFL started in December of 2017. So we see OMFL had a final balance of almost $19,000 compared to VOO of just over 16,200. That's almost $4,000 of difference. And the CAGR wise, OMFL has 13.21% compared to VOO at 9.79. OMFL here had the max drawdown of over 22% last year compared to almost 24% for the S&P 500. Looking at the Sharpe and Sortino ratios, OMFL has them better than the S&P 500. Sharpe and Sortino ratios, the higher the better is the simple rule. So they give us the risk reward benefit. Even here, OMFL outdoes the S&P 500. Now, OMFL is not a dividend oriented ETF, just like VOO. So portfolio income doesn't matter much over here as a factor to consider. Now let's do one change. Let's change the cash flows as like we're contributing a fixed amount of $100 every month and analyze. Even then, the same result, almost $4,000 difference between the two. CAGR difference of almost difference 3.5%. Now let's add in one of my favorite growth ETFs, which is SPGP, which is a growth at reasonable price. Let's add 100 and SPGP. Let's see how OMFL tackles against a growth ETF like this. We see a difference of what, $1,000 between the two. OMFL participates in the growth as well. It's not too far away from a portfolio that has growth considered. So this is what I really liked about OMFL is it's able to adjust according to the market conditions. It gives you growth, it gives you value, it gives you size, it gives you volatility, quality, all at once in one single package. So if you go to Morningstar and for this ETF OMFL, check the historical portfolios, we see it keeps changing based on market conditions. For 2019 and 2020, it was mid cap value. Then in 2021, it changed to large blend. Then for 2022, it went to mid cap value again, and currently it is large blend. So it keeps adjusting to how the market is. And when you look at the past comparison of this ETF with the other ETFs in the same category, which is a large blend, you see over a 5-year period, this particular ETF falls in the top 1 percentile rank of how many? 1087 ETFs. Likewise, in the 3-year category, it falls in the top 3 percentile, and last 1 year, it falls in the top 1 percentile again. So you can see consistently it falls into the topmost category of the ETFs in a large blend. Let's give a final look at some details of this ETF. You see year to date it's up over 4% in the last 1 year. It's just below 5%. Last 5 years, more than 69% returns. Looking at the holdings, now like I pointed out earlier in the video, this ETF has potential to get rebalanced and reconstituted every month. So what you see now may not be the same composition next month. No, I saw it personally because back in February, when the ETF first caught my eye, the holdings were completely different. So right now we see the top 10 holdings are up to 37.5%, and right now healthcare has almost 22%, technology is 16, consumer defensive almost 14, financials is 13.5, industrials is 10.3, energy just over 10%. So this is the current composition, like we saw earlier. So this particular ETF can completely be turned over as frequently as monthly. We dive into the dividend section. Though this particular ETF is not dividend oriented, it has a C plus grading because it has a very low dividend yield of 1.49%. Let's look at the charting and go to a total return, which includes dividends reinvested. You see, in the last year compared to S&P 500, we see a difference of almost 7%. Last 3 years, a difference of almost 24%. Similarly, last 5 years, we see a difference of again almost 24%. So in every way possible, this particular ETF, OMFL, complements your S&P 500 ETF in a portfolio. I will say it again and again. S&P 500 based ETF has to be a core holding in any portfolio. Nothing can beat it out from a peace of mind. You hold the market because everyone is striving to beat the S&P 500 ETF. So you should be holding it at your core and then complementing it with other ETFs like OMFL or SPGP. Like you saw, both of these ETFs, OMFL and SPGP, have a higher risk reward ratios compared to S&P 500. So even though you're adding additional ones to the VOO or the IVV or SPY, whatever, the S&P 500 ETF, these additional ETFs are giving you that enough boost to a portfolio without sacrificing anything. Now let's check how much OMFL overlaps with the S&P 500. So here I'm looking at VOO and OMFL. Look at the overlap. It currently shows 54%. So like we saw, this month's portfolio for OMFL has all the mega caps in the top 10. So that's what is driving up the higher overlap number. Now if I look at overlap with the SPGP ETF, it's just 15%. And when I check with the SEHD, it's an overlap of 16%. The limitation of this website is that you can only compare two ETFs. So I did come across this new ETF comparison website. Here I can compare up to 5 ETFs. So let's look at VOO, OMFL. Let's just compare the two for now. This website is relatively new that I came across. It's cool. You can compare the performance of the ETFs. You can look at how much dividends they are giving, what the overlap percentages, look at the overlap holdings, and also some high-level details of how many holdings and the details of the ETFs. So it's pretty cool. So let's say I give here SPGP also. I scroll down. So here, when I select 3 ETFs, the holdings come down from 286 down to 44. So what I'll do is I'll look at an ideal allocation of how OMFL can sit into a portfolio. We start off with the core holding, which is the VOO, tag on SEHD, our favorite dividend ETF. Now I'll have some small cap value, AVUV. I'll tag along the growth component, SPGP, and OMFL, which are all with the ETF. And then compare. So in here, this is the setup which I would like to see in my portfolio, ideally, where VOO and SEHD are like 50% of the portfolio. The small cap value is 15%. The growth component is 20%. And then OMFL with 15%. It's a floater. It can be large cap at times. It can be mid cap, small cap. It depends. Like we discussed in this video earlier, depending on the market conditions, it keeps changing across. So I can allocate 15% of my portfolio to that, several $1,000. Several $1,000 as an example here. Now here, when I change from 1 year to, let's say, 3 years, and say AVUV is the top performer in the last 3 years, followed by SPGP and OMFL, and then SCHD and VOO. Can I scale it back further to 5 years? You see AVAV drops down because it started in 2019. With a 5-year timeline, we can see SPGP and OMFL are neck to neck, followed by CHD, then followed by VOO. We come down here. This is the dividend distribution. The CHD has its dividend focus ETF will always have the higher one. And look at the overlaps, right? You see here, OMFL is anyways encapsulated by the VOO, so that's why we see it's almost 83 plus percent. In a CHD, it's 12%. In AVOV, a minuscule 0.65. SPGP is under 15%. When I look at the overlapping holdings, here I select all the 5 ETFs. Well, there's none that is common between all the 5. I select 4. So you can see Pfizer, NRG, and T. Rowe Price being the common ones. And I select 3 ETFs. Now that's when the number gets increasing to 77 holdings. So I get a good mix of holdings across these 5 ETFs. You can see here, it's a nice spread of holdings across all these 5 ETFs. Now this is a summary of all of them. So you can see my core holdings here, VOO and CHD have the least expense ratio, followed by the hardworking ones, which have the next 50% allocated among them. This is what a good portfolio should look like, wherein you have your core positions working on their own, you have your booster positions working on their own, and collectively they give an awesome portfolio performance. So, like I've been showing in this video so far, everything that I've seen is what I've discussed. I know historical performance is not guaranteed, but I like the way this ETF is constructed, the way it works, the way it adapts. That's the important thing, it adapts. A passive ETF will not adapt till it reconstitutes. Yes, this ETF is also passive, but it's rules based. It can change month over month based on how the market is. So it is quasi active, which is the best thing to have. That's why expenses are low, 0.29%. I will soon be adding this ETF to my portfolio. Yes, I'll not be jumping entirely into it right away. I'll slowly be adding my position because I'm sure it will reap enough benefits on the long run. So that's all that I wanted to discuss in this video. Hope you all got to know about this amazing ETF, just like I did a few weeks ago. Hope you all found some value from it. And I would really appreciate if you could hit that like and subscribe buttons so that YouTube can suggest this video to many more people out there. And I would really like to know from you all, how does this ETF appeal to you? Do you have any other ETFs that you feel are a better competitor to this? Let me know in the comment section. So until we meet in the next video, try to do as much as possible to be financially healthy and take those continuous strides towards financial freedom.